Well, good afternoon. Ely Gold Royalties is, as Eric pointed out, we have been building our portfolio for about 3 years, and we have a different approach to the royalty space in that we purchase royalties from third parties on producing properties. And we also create royalties, generate royalties, if you will, by purchasing and staking properties primarily in Nevada, but throughout the western United States. We sell those properties and retain a royalty. So we have a revenue generated from those property sales, which we then apply to purchasing other royalties from third parties. A little overview of the company corporate structure. We have just under 100 million shares outstanding, stock trading around 40 cents, fully diluted 127 million shares, so it gives us a fully diluted market cap of about $50 million. We currently have about $2 million in cash and just under $1 million in securities, and about that same amount, $950,000 in debt, which was related to 2 of the royalty transactions that we did. 2019, some of our milestones on the finance side is we got Rick Rule involved. He invested in January of this year and took a 10% position. With his warrants, he's just under 20%. Then in May, Eric Sprott got involved with the company and took about a 5% position. Fully diluted, Eric has about an 8% position today. We operate like a royalty company in that our overhead is very low. Our burn rate is only about $400,000 per quarter, and so with our property sales, we'll generate over $3 million in revenue this year. As you can see on the bottom, our chart kind of reflects really the big change for us after a couple of years of trading in a narrow range. We broke out in January. It's kind of related to when Rick Rule got involved. We also made one of our first royalty purchases in January, and then took a big jump also in about the middle of the year when the market turned, and also when Eric Sprott got involved. So but we still think we have a lot of upside for shareholders. We just recently announced a line of credit. It's a convertible note from Eric Sprott in the amount of $6 million. That will allow us to go out and purchase additional royalties and then control our financing so that we can go and raise equity on better terms and timing, and then pay down the note and then have it ready to draw on again when we see another royalty opportunity for purchase. We only purchase royalties which are producing or very near-term producing, and we generally buy those royalties from third parties. So we're not, as a rule, taking construction risk in the building of a mine. We're not putting up the capital for building a mine and being subject to cost overruns or construction risk. Talk a little bit about the royalty space. The royalty companies are an excellent way on the equity side to get leverage to the price of gold compared to gold equities that in the exploration and development side. We don't employ a lot of geologists and run all of the expenses of exploration. We simply stake our properties. We will spend time consolidating and cleaning up claim packages as far as titles and putting the fragmented claim packages back together, but we don't have all the exploration expense. So in the royalty companies, although there is some construction risk that goes with advancing money for properties that most royalty companies do, you don't have operating risk as far as cost increases, and you get great diversification in a royalty portfolio because the portfolio is spread across different assets with different operators and in different geography. This chart is interesting because it shows that the top 3 gold royalty companies, Franco-Nevada, Royal Gold, and Wheaton Precious Metals, not only handily outperformed gold over the last 10 years, gold would be the line on the bottom of the graph, but those 3 royalty companies have actually also outperformed the Standard & Poor's Index. The growth in a royalty company is important to look at when you consider an investment into Ely Gold, because we are at the emerging stage, really. We've been putting our portfolio together, as I said, for about 3 years. Just in the last year, started purchasing the producing royalties. And what happens as a royalty company grows in size, the valuation that the market puts on the royalty assets grows. So you can see in the top group there, the Franco-Nevadas, Royal Golds, they'll trade at 25, even more times cash flow, and 2 to 2.5 times net asset value. The mid-tier companies, the Sandstorms, Cisco Royalties, those will trade at a slight discount to that, more like 1.5 to 2 times net asset value, and maybe 15 to 20 times cash flow. Then you have a junior royalty space, which is companies like Metla, Abitibi Royalties. This group generally trades more on blue sky and on the future prospects of the portfolio, more so than times a cash flow or net asset multiple. And Ely Gold is at the just entering this junior royalty space, and we've grown the portfolio to the point where when we're compared to our peers, in this case Metalla and Abitibi Royalties, we compare very favorably in the number of royalties, the number of producing royalties, in our revenue stream, but yet we're trading still at about a fourth or fifth of their market caps. This gives an idea of the breakdown of our revenue. Again, we're very active in our sale program. We'll sell 10 to 12 properties a year. So quite a bit of our revenue each year comes from transactions created during that year. So this slide shows that we'll do a little over $3 million this year. Next year, we'll start with what we have on our books, about $2.5 million. And with transactions during the year, we project to be about $4 million in revenue next year. The following year, we have some of our royalties really kicking in and starting to produce. We also have accelerated payments coming on our sale portfolio. So we'll start with about $4.5 million, and we're projecting about $6 million in revenue in 2021. And you can see from this, the gray is the royalty revenue, the blue is the sale revenue, and see that it's fairly well matched there, that we generate revenue about half and half from option, sale revenue, and royalty revenue. This chart shows really, again, mostly our stock down at the bottom, and shows that compared to some of the other royalty companies, beginning this year when our stock broke out, we traded along with the GDXJ for the last few years. But as we started purchasing royalties, getting out and marketing the story, we've started to trade much more like a royalty company than a junior exploration company. This is a slide we're very proud of. Our properties throughout Nevada, we currently have over 70 projects properties that are in play. The breakdown on that is 34 royalties, 22 properties that are in the sale process, and about 25 properties that are available for sale. And as you can see from this slide, if you can see it, we pretty much are doing business with all the major and mid-tier companies that are operating in Nevada. Talk a little bit about the 4 royalty purchases we've made this year. We, from a third party, picked up a 3/4% royalty on the Isabella Pearl mine that Gold Resource began construction on last year, started producing this year. Last month they declared commercial production, so that royalty stream has started for us. The Lincoln Hill is a royalty we bought again from a third party. It's a 1% royalty on the a deposit there that's at Coeur's Rochester mine, where they're building a new leach pad, and we are projecting late 2022, early 2023 for revenue there. We also purchased a royalty on the Jarrett Canyon Mill. This is an asset owned by Eric Sprott, and that royalty increases with the price of gold. We get paid on a per ton basis on everything that goes through the mill. We were very attracted to this asset because the mill there is now with the joint venture of Barrick and Newmont in Nevada. The Jarrett Canyon Mill is the only roaster outside of that partnership that can process the refractory ore that is so common in Nevada. So what we purchased this, it's currently paying us on a monthly basis, but those payments increase with the price of gold, where it's almost at $2,000, $1,600 gold, the payments go up 30%, and then they go up another 75% at $2,000 gold. And we expect production, the mill is rated at 4,000 tons a day, currently producing 2,500 tons a day, but they are now taking in toll milling from other companies, so we expect that royalty to just continue to increase. And the last one that we purchased this year outside of Nevada is on the Walbridge Fenelon property. This has been a very exciting package here, land package that Walbridge's been exploring. They've also, oops, we lost our.
Yeah, that's been happening all day.
Okay. Anyway, I kind of know this story. The Walbridge Fenelon, that mine is built there, and they're now doing underground exploration. They announced some results 2 weeks ago, 27 grams over 38 meters. They've applied for their permit there for 400 to 500 tons a day of production, and we expect that to start producing late next year. Talk a little bit more about our property generation. What we focus on in Nevada is identifying properties that are at or near producing mines. This is very important for us in building the royalty portfolio. Most of our properties, because they are near producing mines, they're being explored by the companies that are producing at those mines, that are operating the mines, and to extend the mine life and add reserves, and it could go into production much sooner. We don't have to wait for all the permitting, and we don't have to have our property generate a deposit big enough to build all the infrastructure of a mine, because it's there and already built. So a few examples here at Gold Resource. I mentioned before that we had a 3/4% royalty on the production there. But when we got word that we knew somebody was going to buy that mine, so we had staked all the property around it. So all the exploration ground there, we sold to Gold Resource and hold a 2.5% royalty. They're beginning to explore that mine to extend that land to extend the mine life now. We also sold them 2 satellite projects, Mina Gold and County Line, which are 10 miles away. Those they're starting to explore, and they are past producing mines, so we know there's gold there. And they'll either drill those out and become satellite mines and share infrastructure, or they'll haul that ore the 10 miles over to Isabella Pearl. Fiore Gold's a company that's here. Their key project now, they're producing at the Pan Mine, and about 10 miles away is their Gold Rock project. We have 2 royalties there. McEwen Mining has just completed in April, declared commercial production at their Gold Bar facility in Nevada. We have 3 properties, 3 separate properties there with royalties on them within their mine complex. We have a property in the complex at Turquoise Ridge. That's part of the Newmont-Barrick joint venture now. It's the highest producing mine in Nevada. It's the highest grade producing mine in Nevada. A couple other ones that aren't on the screen now. At Premier Gold, they have a joint venture with Barrick at South Arturo. We have a claim package in the middle of their land package there with a royalty on it. And they've started exploring that ground. Again, the key to all of these assets is they do not need to. Any gold they find there is going to get processed, whether it's 100,000 ounces or 1 million ounces. So our profile of our royalties, we're going to see royalties kicking in from the sale portfolio, these development royalties, over the next few years. Integra is another company that we're involved with in Idaho. We had a state lease on some ground there at the old War Eagle mine that we sold to them and retained a royalty. So go back here. Just to sum up again, I think I mentioned already about this slide, about the properties that we have spread across Nevada. We're able to locate and stake these properties because our head geologist, my partner Jerry Bachman, he's been doing this for over 35 years, staking properties, and successfully built a royalty portfolio that was sold to Frontier Gold, and then, of course, Frontier was purchased by Newmont. To just mention one other thing about our sale portfolio. To be clear, with our properties, we don't do any joint ventures. We simply sell the projects, as I mentioned, generally over a 4-year time frame, with escalating payments. Generates continuing revenue for the company, and it's a very scalable model. We don't have any management time in these projects once they're sold, and every property we sell, we retain a royalty. I mentioned Jerry. Again, going back to the burn rate, we operate very efficiently. Jerry and myself are the only 2 full-time management employees. Our CFO and corporate secretary and QP are both part-time and operate out of our Vancouver office, which we share with another company. We also have an office, our corporate office is in Reno. Independent board members, Bill Sheriff, again, a longtime Nevada prospector, and Bill adds a lot to the our search for properties and royalties. So just summing up the upside for shareholders from this point, we feel we're still very undervalued compared to our peers, and that every time we add another royalty and another sale to our portfolio, we get a re-rating or get closer to being rated more in line with our peers. We're more aggressively growing our portfolio than our peers too, in that we are not only purchasing the royalties but generating them. And important to note that when we purchase a royalty, it's one that's paying or near-term production and going to be paying. And the exploration and development royalties we're generating out of the property portfolio. The royalty space in general is kind of seeing a renaissance as new investors are coming into the gold market and some old investors are looking at gold equities again. The royalty space is starting to be more and more recognized as the best risk reward in gold equities. And of course, the last thing is the leverage to gold price is when gold prices go up, our revenues go up. All our revenue projections, and the chart was based on $1,400 gold. And when the price of gold goes up, the revenues go up, but our costs do not go up. And the last thing with that gold price is we're asked the question a lot of times of, well, with gold prices increasing, are you running out of properties, or are you, is it getting harder to find the royalties? And the answer is just the opposite. At the higher gold prices, some of the projects that were maybe not economical at $1,200 to $1,300 gold are being dusted off and being considered for construction. And of course, we're out there now staking around these projects that we know at higher gold prices will get developed. So that's it. That's the presentation for Ely Gold. We will be here for the rest of the afternoon. If you want to stop by, we've got some printouts of this presentation, and of course you can go to the website and follow it. And also, if you stop by or you go to the website and sign up, I do a podcast every 6 weeks with O&M Partners. So that's an opportunity to get updated. I generally do them in the morning so that European investors can pick it up in the evening. So,
Thank you very much, Trey.